Hello, everybody. My name is Alesh Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This is my thoughts on market happenings for the week ending November 25th, 2022. Looking at the market indexes for the week, the TSX, the S&P 500, Dow Jones, Nasdaq, and Russell 2000 were all up significantly for the week. Oil was down, but gold was up, possibly as a safety from the issues in the crypto industry. Part of the reason for the large swings this week is the low trading volume as traders take off for the US Thanksgiving holidays. When there aren't as many stocks trading and there aren't as many market moving catalysts, the fluctuations can look outsized. So let's take a look at Canada first. Retailers are still struggling with high inventories of products, which will likely lead to markdowns and lower margins in the coming Christmas season. Some of the double orders have arrived only recently and caused inventories to pile up. Note that inventory structures and processes in the future will be quote unquote just in case rather than just in time, following the supply chain issues we've seen recently thanks to COVID. Carrying inventory is costly, whether it is of parts or of the final products, but if there's no products to sell or no parts to make your products, the whole business grinds to a halt and it may be worth it to carry some inventory. The supply chain issues are anecdotally clearing up. The ships that used to be lined up outside US ports for 40 days waiting to unload are now taking 5 days, so the situation has improved. There is a consensus with energy experts that 2023 will have a tight oil supply, with reasons like the Russian oil not being purchased with the sanctions kicking in, and the overall lack of oil and gas investment and low production, including Saudi Arabia. Oil price is expected to have little effect on oil supply. It's not possible to produce much more than we are right now. Canadians who have variable or floating rate mortgages who are probably going to feel the impact of higher interest rates almost immediately. They're starting to get letters in the mail that they've hit their quote unquote trigger rate, where their payments are not keeping up even with the interest. Lots of people who had very low interest rate mortgages that have been impacted by the rate increases, and they need to increase their payments as a result. Canadian inflation is coming down with cheaper rents, cheaper gasoline, and other commodities, the supply chain issues clearing up, and the price of shipping a container being back to pre-COVID lows. Bank of Canada is still going to hike interest rates, but at a slowing rate, with perhaps a pause and possibly some rate cuts if a deeper recession happens. This is good news for the markets, including the shareholder-friendly activities companies are doing, such as increasing dividends and buying back shares. The Canadian dollar has strengthened against the US dollar because while the US Fed has softened its stance on interest rate hikes and seems to be slowing, Bank of Canada, despite our inflation being lower, is still hawkish and is suggesting more raises are needed. Turning to the US, the inflation has peaked in the US, but inflation needs to go back down to 2%, and it is still around 8%. The Fed will keep talking the market down, sticking to its hawkish approach. Investors and Fed watchers are expecting the central bank's policymakers to increase rates again in December, albeit by just a half a percentage point after 4 consecutive three-quarter point hikes. The Cleveland Fed President Loretta Mester said she supports slowing down the pace of the increases. Quote, "We're going to have more work to do because we need to see inflation really on a sustainable downward path to 2%. We're still going to raise the funds rate, but we're at a reasonable point now where we can be very deliberate in setting monetary policy," end quote, she said. US stocks surged around the release of the US Fed minutes on Wednesday, which generally confirmed what traders had already suspected, that the U.S. central bank anticipates stepping down its rate hike soon and will mostly raise interest rates by only 0.5% of a percentage point in December. A higher terminal rate is possible, with a possibility of 0.5, 0.5, and 0.25 the next set of meetings. The rate increases are slowing since the inflation is decreasing, but more hikes are needed on both sides of the border. In the U.S. weekly jobless claims numbers, they rose by 17,000 to 240,000. This is bad news, which is being taken positively, possibly causing the U.S. Fed to raise interest rates less. In the third quarter of this year, companies generally performed better than expected. As of the beginning of November, when 429 of the 500 companies in the S&P 500 index had reported their results, 57% of that group beat analysts' earnings per share expectations, according to Bank of America. That's despite persistent inflation and the looming threat of recession. The trend has continued later as well, with major companies like Home Depot and Walmart beating analyst expectations in mid-November. The company's stock surged 6.3% on Monday when Disney announced Sunday that former CEO Bob Iger would come out of retirement to immediately replace Bob Chapek, who had been at the helm of the entertainment giant since February 2020. Bob Iger began by shaking up the top management team. The hope is to turn around some of the issues Disney has been having, including weak numbers from Q3. The computer company HP Incorporated said Tuesday that it would lay off between 4,000 and 6,000 employees over the next 3 years as demand for personal computers weakens. The announcement came as HP released quarterly results that included a 13% year-over-year decline in revenue for its business segment that includes PCs. The company's plans also came after other tech companies such as Facebook, parent Meta, Salesforce, and Amazon all said they would cut jobs as their businesses adapt to a steep decline in demand from early days in the COVID pandemic. Perhaps the central banks will finally get their wish with higher unemployment rates, leading to lower demand and lower prices. Finally, a few bits and pieces. China is reintroducing COVID closures this week from a COVID surge, especially in Beijing, bringing down the market early in the week. China's population isn't really well vaccinated since they didn't roll out their vaccines as North America did, for example. Beijing has had its first COVID death in 6 months, leading to significant shutdowns. Officials from nearly 200 countries agreed to create a new fund to pay poor nations over the damages they experience from climate change. The deal came at the COP27 conference in Egypt. Nations also agreed to stick with their goal to keep the global temperature increase to the threshold of 1.5 degrees Celsius above pre-industrial period levels. This agreement also drew some criticism. COP27 was kept alive, the goal of 1.5 Celsius. Unfortunately, however, it has not delivered on a commitment by the world's major emitters to phase down fossil fuels, nor new commitments on climate mitigation. European Commission President Ursula von der Leyen said in a statement. And finally, turning to next week, we have some companies reporting next week. On Monday, we have Pinduoduo. On Tuesday, we have Bank of Nova Scotia, HP, and Shaw. And on Wednesday, pretty much the rest of the Canadian banks reporting. We have RBC, National Bank, and on Thursday, we have Toronto Dominion, BMO, and CIBC. And Friday, it's the Canadian Western Bank. Economic events next week. On Tuesday, we have Canadian GDP with a 4.4% annualized quarter-over-quarter growth expected. On Wednesday is the US GDP with only a 2.8% quarter over quarter for Q3 expected. And we also have US oil related numbers. Thursday is US personal consumption expenditures and personal income, indicating the health of the US consumer and the economy. And finally, on Friday, we have US payroll data and Canadian unemployment rate for November with a 5.3% expected, up from 5.2% rate in October. So that concludes my thoughts for the week. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.